Well, there we have it, our Fed-induced market crash as discussed in the weekend update. And there are still Magnificent 7 earnings and the Friday labor report to keep us on our toes. So Powell, thanks for doing what you do best, but we need to do what we do best, and that's building a logical game plan to navigate the end of this week. As always, check out the links listed down below in the description. The first one down there today is our 2024 Macro Themes Outlook Report for all the folks interested in the fundamentals. Hit the thumbs up button and subscribe if you've not already done so, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. Let's kick things off with a closer look at the SPY daily time frame chart. What do we see here from a structural point of view? Solid red-bodied bar with a meaningful range. It closed incredibly weak, dead on the lows of today's trading session, and this is on the heels of a gap down this morning, so the buyers are unable to correct the overnight inventory and close the thin structure overhead. Another bearish indication, largely due to the Google, Microsoft, and AMD earnings, right? So bears immediately in control with momentum to the downside. And I would also argue that this is not directly a bearish engulfer of the previous day's range. However, if we think about this slow grind in the upward direction before the more meaningful breakout to the all-time high, we've engulfed all 5 of those grinding days to the upside in one day with momentum to the downside. So again, in the immediate term, momentum is lower, but let's not forget about the daily trend, which is certainly still up, right? We have lows, higher lows, and along the way, highs, higher highs, higher highs, higher highs, and higher highs, new all-time highs. And this is where we're pulling back from. We're not pulling back from a lower high. We're pulling back from the highest high in the trend sequence, which means that the door is open to find a firm daily higher low. And the reason I emphasize firm daily higher lows is because these are technically soft higher lows where we never actually flipped into an hourly downtrend. With today's bar, yeah, we're definitely in an hourly downtrend, and we're looking for a more meaningful daily higher low to preserve the overall uptrend here. So there's really 2 ways I can see this unfolding. The first way is a sweep underneath this level right here at 482.85. The reason why this level is weak is because it represents the improper end of the auction. The touches back here are far too precise, and remember, it also technically represents a gap fill reversal from the Monday session of last week. So we went right to it on today's session and stopped. Again, this is the improper end of the auction, having all of these touches directly at the same price. Generally speaking, you want excess at any major low and excess at any major high. This does not represent excess considering how precise, right? So the first way, and the most bullish way in my eyes, is sweeping underneath this level to repair the structure and then closing back over 482.85 to end out the week. And perhaps it looks something like a hammer candle via a combination of days on the Thursday and Friday session, but it's twofold. Not only are we repairing the structure from this improper end of the auction to the downside here, but it also represents a failure from the sellers to really move through the thin structure breakout here on that Friday session, right? If we dip a toe into it and the sellers can't continue this downside momentum, it's a pretty big giveaway that, all right, it was a one-time deal reacting to the FOMC. Now the buyers are stepping back up. Remember from the weekend update, our main argument was that we had weak-handed longs up here. If we've finally shaken out those longs and we're going to give better strong-handed longs an opportunity to enter this market, that would be the most bullish interaction, right? Sweep the low, repair it, do not find stronger sellers through that thin structure, then close the week back up and over 482.85. That's situation number 1. Situation number 2 is recognizing that, yeah, this is definitely some more meaningful downside momentum, and if we start to see solid red-bodied bars, it wouldn't be unreasonable for a full retest of our daily line in the sand at 477.50. Remember that this represents the top end of the balance area here. If we're trying to build out a new Lego, a new brick in the upward direction, generally speaking, we do not want to fall back down underneath that level. Now, just as a general disclaimer, we're not blindly buying this if the momentum is clearly red and in the downward direction. You're not just putting orders here and hoping that they get tagged and then magically there's going to be some sort of reversal. But on the hourly time frame chart, I would be highly attentive to, as we start approaching that level at 477.50, can we start to see hourly double bottoms? Can we see an hourly inverted head and shoulders? Can we find a daily hammer candle around that particular level? And it might not happen on the Thursday or Friday session this week. It could take Thursday or Friday to get there. And then early next week, we look for this area to act as a potential higher low. The only risk that I can really see with this as a situation is that if we move here, it's a pretty deep pullback. Don't get me wrong. It's retraced a big bulk of this rally that we've seen off of this higher low. However, The larger risk is then setting a daily lower high underneath the retest of this level at 482.85, right? That would certainly start to get me concerned about a daily trend reversal. We're not there yet. We're sort of speculating right now, but just to prepare you for a potential risk, that is what we're concerned with, right? So just to recap, something into the end of the week that looks like this, very bullish with a close back over 482.85, something that gets us down here, thinking about potential reversals around 477.50. And of course, the sort of unknown, if we do get a large breakdown of that level, much larger red flags, and we will certainly have to reassess from probably a weekly time frame perspective. But as of right now, and as you'll see as we move through today's video, the supporting evidence charts are really not that bad. The sectors remain bullish, the risk appetite charts remain bullish, and even the market breadth remains bullish as this pullback has taken place. So I would really forecast this as a lower probability outcome. But again, anything can always go in the market. With that said, let's take a look at the hourly. So how did we arrive at this particular point? The story of how we got here is actually very important, right? This was an ascending triangle breakout on the Monday session, and then on Tuesday, we produced bullish inside bar consolidation in the upper third of that breakout. Now this morning, Wednesday, we opened on a gap down, but we gapped directly towards the breakout level right here. So if we think about this logically from a trend point of view, it was totally possible for the buyers to find a higher low here and then close the gap overhead, hopefully working back into the Tuesday range, maybe setting up a breakout up and over that 491.50 to move into all-time highs, blue sky territories, right? And obviously we know that there's something different going on here. We had an earnings catalyst obviously overnight, and then Jerome Powell steps up at the 2 o'clock time frame. So really the catalyst changes the tone of the market structure, right? Now that we have catalysts sort of unfolding and the structure has also changed, it's worth understanding that you probably don't want to jump in here blind until the hourly structure reverses back in the upward direction, right? If there was going to be no change in structure regardless of the catalysts, buyers could have, before the FOMC, found a reason to get a higher low here and close the gap overhead. It simply did not take place, so it's worth respecting the short-term momentum in the downward direction, not only based on the FOMC catalyst, but this lack of hold for a higher low as well over the top of our breakout point over here. So, all right, that's squared away. Then once Jerome Powell actually gets on the mic, notice that there is some lift in this upper wick, but where do we reject? We reject the high of day. That acts as your hourly lower high, right? So you have a high, now you have a lower high here, and you have lows, lower lows, and now lower lows into the close as well from today's session. So as we described on the daily, it wouldn't be unreasonable to sweep underneath these very precise levels at 482.85, get a little bit further of a lower low, and then if we snap back above, it's all about where is the lower high set. Now on the hourly time frame chart, you can see that any rejections underneath 486.50 would make a lot of sense, right? So we maybe move a little bit lower, then reject something that does this, and then if we can get that daily close, or the weekly close, I should say, by Friday's close, over 482.85, we start to build out an opportunity for a larger hourly trend reversal via something like maybe a double bottom. Maybe it looks like an inverted head and shoulders where maybe we rally a little bit first, then sweep it, then maybe do something like this into Friday, right? And that starts to suggest your hourly trend reversal where this holds as a daily higher low. So that's the bullish situation. And then of course, obviously you need the break back up through this. And then we're aiming for the equal high. Gap closes a target, then equal high 491.50. So that's the sequence of events to reverse the hourly trend and hold a daily higher low. If we migrate lower, I would not really be chasing new money shorts after this lower low has been produced. I mean, the name of the game in any trend is never chasing a higher high in an uptrend and never chasing a lower low in a downtrend. We want to enter on a lower high. So if we are going to continue in the downward direction for the larger pullback we described on the daily time frame chart, I would look for an extension through this level, then try to spot the lower high underneath 482.85, and then get continuation into the end of week into 477.50. The other thing that could take place again is any sort of rally here that then rejects. You could also position for shorts up against that 486.50. The name of the game is reducing your risk reward ratio, right? If you can take an entry here with a stop just above, because that would invalidate your short entry, right? And then retarget this, of course, I mean, that's easily a 2.5, maybe 3-to-1 risk reward ratio. That's the type of trade that we're really aiming to take, right? So that is the technical view from a pattern perspective. Let's take a look through the lens of a Fibonacci coming in from the daily higher low low up to the most recent high. And the main illustration here is that your 38.2 is going to unlock that thin structure over here, and your 61.8 is still technically confluence near that daily line in the sand at 477.50, reinforcing both of these levels. So 482.85 and 477.50 works out from a Fibonacci point of view as well. Let's quickly throw on the anchored VWAPs, and then we'll move into the market internals. I think that this mostly aligns with the potential threat for a lower high on any rebounds at 486.50, right? If we start moving in the upward direction, these two anchored VWAPs, which I would argue are a little bit more meaningful, it's this gap up from the Wednesday session of last week and the Monday anchored VWAP from this week when the breakout took place, right? If those are going to act as rejections, you'll get beautiful confluence at that 486.50, potentially offering up a place to short against with meaningful risk reward, right? So that is possibly another area of potential confluence. So the main levels to have on your screen here as we move into the end of the week, just to recap them one more time, 486.50, 482.85, and then down below 477.50. With that said, let's take a look at the market internals. So Exhibit A, as always, if you're not familiar with this screen, check out the video tutorial in the top right-hand corner. And what we need to assess is what was taking place today on the Wednesday session ahead of the FOMC 2 o'clock timeframe. So I'm just going to highlight everything here. And I want to remind you very briefly about the price action itself, which was a breakdown underneath Monday's breakout point. Here's Monday's breakout. Here's the morning breakdown ahead of the FOMC, right? If you look at the market internals here, bullish or bearish or neutral, I would argue much more neutral than anything else. Same thing here in the advanced decline line being closer to the zero mark, and the tick, I mean, tangled around zero, but just looking at the cumulative, really nothing aggressive to the downside. Now, if we look at how we closed out, yeah, we'll concede that, sure, there were substantial volume outflows. We got close to trend lower zone, but we never actually got into it, and we did have a little bit more of a meaningful downside build, but let's compare this back to the Monday breakout. Volume flows not as bullish on a relative basis. In terms of the advanced decline line, I would argue that this is slightly more bullish, battling back from a negative open, grinding to the upside and accelerating towards that trend higher zone. And look at the cumulative build out of the tick. This one really speaks for itself, right? On a relative basis, we have, let's just call it 4,500 for round numbers sake, and down here, let's go 3,275 to the downside for today. Remember, a substantial read is somewhere net positive or negative 5,000. We didn't get close on today's session, a little bit closer on that Monday breakout. So the main illustration when we look at this supporting evidence is just that should we be aligning with the daily uptrend and trying to find a higher low opportunity? To me, the answer at the internals level, the exchange level, is absolutely yes. Market profile is always Exhibit B. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Let's firstly evaluate value area and point of control for this week. Here's Monday and here's Tuesday, a very important interaction where Tuesday's value area and point of control are completely breakaway to the upside, but more importantly, they're in the upper distribution of the Monday session. Remember that Monday is separated into a double distribution via L period single prints right here. So seeing that value area contained in the upper distribution, we'll call that D1, is a bullish indication, more indicative of buyers participating in that bullish consolidation after the breakout from Monday. So to see the open lower this morning instantly puts all of those buyers off sides, maybe helps to explain why we saw some early morning downdraft instead of a hold near the top end of the breakout area over here. But that aside, look at the value area on today's session. Even with the FOMC, it's mostly contained inside of the 3-day balance range from Wednesday, Thursday, Friday of last week. And the point of control is certainly smack in the midpoint of that range. So what would that suggest? First of all of this can act as overhead supply if we get a lower high underneath 48.95 in the futures. That's roughly the equivalent of our 486.50 in the SPY cash, right? But here on the market profile, we can actually see how that also represents single prints in the L period, very similar to what we had on Monday, but the inverse, obviously in the downward direction. So if this is a double distribution, rejecting the upper distribution, which is the equivalent of that 48.95, keeps the bears in control because this continues to act as overhead supply, weighing on price in the downward direction. If we can poke into that balance range, things improve because we know the average position held in this range, as we evaluated last week, is not technically slammed towards the top of the balance, right? People do not hold a net position in this portion of the range. It's really more central in this portion of the range. So as soon as we can get back towards the midpoint there, feeling much more neutral and constructive about this being an excess low, and then looking for a rotation in the upward direction. And also, just like we talked about this acting as a very precise and equal low, being the improper end of the auction, you can see the futures actually ticked through that a little bit more firmly than the SPY cash. But the same concept applies near the highs. And generally speaking, at the all-time high, this is not what you want to see the market go out on, right? So the door is open for a structural repair at the all-time high. You want to see excess at the highs, everybody agreeing that, yes, this is finally the high. Think about an auction, right? The classic one is to think about a car auction when finally it's two bidders going back and forth. Everybody else has bailed out of the auction because they're like, you guys are crazy. You bid that thing up and we'll let it go, right? That's when you lose participants. This does not suggest the lack of participants. You can clearly see the bullish consolidation on that Tuesday session. So if we're searching for an excess high to, again, think about it from a participant perspective, find two people bidding it up till the very bitter end, and everybody else has already backed off, that is going to represent a much firmer all-time high that can stick. This is the improper end of the auction. That's the main theory we're trying to get across here. So the daily higher low being constructive to trade back up towards the all-time high makes sense for repairing this structure and then looking for a more meaningful all-time high to be set, which respects auction theory, structural theory, and then we'll take it in stride from there. So just a back pocket situation to have that all-time high in your ES futures is much closer towards that 49.55. And as we know, if we were to slip underneath, let's just do this. If we were to slip underneath the two equal lows we talked about on the SPY, this of course is thin structure via thin volume commitment at price. We are looking for that deeper daily pullback towards the SPY 477.50 level. And here on the ES, we're talking about the origin of that break basically, which is further towards 48, let's call that 17. Changing gears to the QQQ on the daily time frame chart, you can see a staggering amount of relative weakness here. We've already broken down through the two equal lows. We've started to retrace some of the thin structure from the breakout 2 Fridays ago. We've got a very weak close dead on the lows of today's range. The upper wick is a little bit more meaningful than the S&P. However, what does it reject? The bottom of this as overhead supply. And another relative weakness indication is that Monday's breakout did not yield a higher high. It did not yield a new all-time high. It's technically speaking a very nuanced lower high compared to the Wednesday session of last week. So short-term trend followers know that this is an hourly downtrend here. So this starts to act as your daily high or low. When we try to reverse it via the Monday move in the upward direction, this now as a lower high is concerning underneath your last daily high or low. Now, I would still make the argument that we're still looking for buyers down here. You could start thinking of it as a weekly high or low. I would still probably consider it a daily high or low. We have lows, higher lows, higher lows, right? So that's 412.75. Prior resistance has the opportunity to act as newfound support. It's also a gap fill underneath 414.60 closes at 413.55. So just like the S&P, I would say that there's not as much obviously of a chance as coming back up and over this to just indicate a quick sweep underneath. This has already been more than a sweep, and that upper wick would show a rejection of that price level in the first place at 421.25. So some continuation lower and then looking for buyers in this range makes a lot more sense to me out of the NASDAQ. If we're going to start changing our tone on the long side of the NQ market, I would not only want to see a recapture of 421.25, but probably the bottom of the 4-day balance, which is closer to 423.50. If we can get back up and over this level right here, that would be more meaningful on a consolidation move. This acts as like your weekly or daily high or low, depending on how you want to view it. Then an equal high breakout is on the table for new all-time highs. So much more work needs to be done in the NASDAQ if buyers are going to regain control via some sort of immediate reversal back in the upward direction. If we do see that extension lower, still looking for buyers to step up around this zone, and the line in the sand, as we know, comes from the 3 equal highs, which are down here at 410.25. So this is not technically the end of the world if we break it. I would still argue that the weekly higher low can be found here. And at that point, definitely a weekly higher low. This would no longer be like, okay, maybe it's a daily higher low. At that point, weekly higher low at 410.25. Let's move along and take a look at the hourly time frame chart just to understand how this as a double top is in force, right? And there you go. It's going to require the recapture of the neckline there, not just 421.25. It's a good first step, don't get me wrong, to get here, but the better interaction is not getting another hourly lower high up against 423.50. So we need the recapture there if you're going to flip to being a bull again in the short term for our QQQ. If we're looking for trend continuation to the downside, let's count trend. We have highs, lower highs technically, lows, lower lows. That's the hourly downtrend we were referring to on the daily, right? So there's your hourly downtrend, highs, lows, lower lows, certainly lower lows here. And this is your last lower high, right? The rejection of your neckline already in the upper wick from JPAL. So if we do get a move higher into the end of the week, any rejections here now are still a lower high up against 421.25. And then trading in the downward direction to see what we can get down here for that gap close again. 414.60 closes 413.55. Line in the sand understand structurally is at 412.75. And we know the name of the game. When and if we get down there, looking for hourly double bottoms, looking for hourly inverted head and shoulders, and even something that just forms a very simple hammer candle down there is constructive. We have thin structure to retrace, so that move can happen sooner rather than later. Let's take a look through the lens of the Fibonacci to be congruent with what we've done over in the S&P, and what we'll do is we'll come from this daily high or low up to the most recent high. 61.8 is confluence with that 412.75, so probably again giving the buyers some benefit of the doubt when and if we can extend into that area. Then lastly, we'll finish up the candle chart at least with our intraday VWAPs, and you can see that we have beautiful confluence on either rejections for a lower high here first, or if we're going to recapture more meaningfully all of these anchored VWAPs, getting over that 423.50 is much more meaningful for the buyers to start exhibiting some relative strength near the highs. Let's move along and take a look at the market internals for the NASDAQ side of things. You can see that Monday's breakout was much more meaningful, but Tuesday's consolidation was not just consolidation in the NASDAQ side of the market. Same thing here in the advanced decline line. Tuesday's a little bit more meaningful. Same thing here in our cumulative build out of the tick. However, on today's FOMC breakdown, notice that you didn't really get sustained bearish pressure in the morning. It was that afternoon, and it wasn't even as bad as what we saw on Tuesday. So Tuesday is the nail in the coffin. And again, the fact that we could not hold, if we just go back to the hourly chart actually for a quick analysis, on Tuesday, when we opened technically above this 426.25, there was an opportunity for the buyers to remain in the driver's seat. Although technically we would not have been in as firm of a daily uptrend because of the lack of breakout from the balance range on Monday here, we would have been above the key level, the Wednesday low, the Thursday opening range lows, the afternoon lower high, the lower high on Friday. If we could have held this on the Tuesday session, that would have been much more constructive. The fact that we lost it on more bearish internals, again, speaks to me that if you're looking for stronger shorts in the market, the NASDAQ is still the place to be. Let's take a look at the market profile for the NQ side of the futures. What do we see over here? Value area continues to march in the downward direction. You can see that we get something that looks like this. Here is that Tuesday, right, with the failure to hold up and over. Basically, it was the equivalent of this zone right here. No hold over the top. Value area and point of control were underneath, as they were on the Monday session here before the breakout. And on today's session, value is meaningfully lower. There is no overlap with the previous range like what we have in the S&P 500. So again, if you're looking for shorts, the NASDAQ is the more constructive place to do it. You will notice that we do not have single prints over here. And instead, I would argue that any lower highs that we've already talked about on the cash side of the market, but in the futures, just want to be up against the high of today's session. Anything that continues to reject that is bearish, and anything, I believe it was slightly underneath. Let's quickly go back on over to the cash market so we can find, okay, so the two equal lows from back here is what we want out of the futures market. So let me scroll back and find that for you via our market profile if it wants to cooperate without getting funky. It's basically value area high. So I like that from a mechanical point of view. Notice that today's value is right here. So value area high, 17,400 is going to be the potential for your cleanest hourly lower high that does not come in for a full test of the previous high of day. And what about the IWM Russell 2000 and the small caps on a daily time frame chart? We got to talk because this is not a constructive continuation look of the daily inverted head and shoulders that we were looking at. Remember, we were trying to cement a weekly higher low around 187.75. Recall that the daily downtrend is here with a lower high and a lower low. If we're going to reverse that, we need a higher low in the right shoulder. We need to break the neckline and bring in a higher high. An equal high would be ideal on the weekly chart. And then yes, this acts as your weekly higher low, and you're in a daily uptrend. Clearly, with today's breakdown, the right shoulder of the pattern is going to start acting as overhead supply. We've closed underneath, and it wouldn't be unreasonable for an equal low down here considering the downward pressure that we could potentially experience. And the issue with that is now we have a weekly lower high with an equal low. If we trade back down to here, this could be construed as a weekly double top underneath the neckline, and you can kiss this thing goodbye. We're no longer as constructive on the broadening nature of the market rally via small caps participation in some sort of catch-up trade, right? Now, the one thing that we might think about is, okay, well, there's technically the possibility for a gap fill reversal. Maybe the daily 50 SMA will provide a higher low as well, and it's still on the table. We have not traded to the equal low yet, so we're not writing it off in its entirety, but the structure on today's bar really not that helpful. A lot of work needs to be done on the recapture of 196.50 if we're even going to thinking about a breakout of 199 for the head and shoulders, inverted head and shoulders to trigger here on the daily time frame chart. And the hourly chart does a better job of explaining why. We've talked about 196.50 for quite some time now, but just as a reminder, the gap up did not yield a higher low above. We opened at the same location, no higher low above, no higher low above, same thing here. Monday's breakout was a great first start. Tuesday sideways, nice. Even this morning, ahead of the FOMC, notice in the first couple of hourly bars, the lower wicks show buyers trying to step up there around 196.50, clearly into the close of day, right down underneath this as now overhead supply. So if something constructive is going to take place, you need to look below and fail. A good first step is a higher low over 194.10, but you really need to be over 196.50 because if you reject there for a lower high, you're still stuck in an hourly downtrend. You have equal highs, lower high underneath 196.50, and you can still trade this in the downward direction for the weekly equal low at 187.75. So that's the threat that I'm seeing here out of IWM, and it really all revolves around still that level at 196.50. Let's take a closer look at some VWAPs and the Fibonacci's. And the Fibonacci point of view here, before we jump into those VWAPs actually, is going to come from the top of the move to the bottom of the move over here, and these really reinforce almost all of the levels that are relevant here. The 61.8 offered rejections near the highs. No love over that level, and you're likely not going to produce your weekly equal high. So 199 is still a valid breakout level from that point. The 38.2, the more time we spend underneath it, the more likely it is that we travel back down towards this area. It would be back down towards the 0% fib, or just the equal low down below. And again, we've broken down underneath. It is technically the bottom end of the range. So even if we go for a minor gap fill reversal, let me zoom in on this a little bit more. Even if we go for a minor gap fill reversal, but reject at 194.10, the bottom of this balance, you're still stuck underneath your 38.2, and the odds would increase for the retracement back down to the equal low again, 187.75. So that's fairly concerning from a fib point of view. Let's take out those intraday anchored VWAP, see what's going on here. I think it really reinforces just the top two being confluence with that 196.50, involving, or requiring, I should say, consolidation up here above the anchored VWAP band before we even start thinking about 199 breakouts. Let's take a look through the lens of the market internals for the Russell side of the market here. And as Tuesday was consolidating, the cumulative build was the most bearish internal, but the volume flow is not too bad, and we're technically trending higher, although in negative territory on Tuesday. Monday's breakout, it was okay. Not in trend higher zone, but attempted to get there. Not substantial volume inflows, and the same thing can be said here on the cumulative build. As we were just consolidating, I would have liked to see a stronger cumulative build on Monday's morning consolidation before that breakout to really have more faith in this move to the upside. It was flat. You can see it was flat as a board on that Monday session. Today's breakdown, similar comments to the ES and the NASDAQ, with mostly consolidation ahead of the breakdown, nothing crazy. Notice that Tuesday's midday breakdown was even more aggressive than today's FOMC breakdown, which preceding we did have bearish consolidation taking place. So internally, it leaves a little bit to be desired. I would say that there's a little bit more of a bearish edge happening here in the Russell internals compared to something like our ES on a relative basis when we mix in the price action and where we are structurally. Let's take a look at the market profile for the Russell, and you can see that the point of control, this is always a classic out of the Russell. In like the last little bit of the trading session, they always push through the most volume, and there it goes. So your point of control is lower in the M period spike. We do technically have some single prints separating an upper from a lower distribution, and all of this should make sense. It's the same concept as the Russell hourly chart, the daily chart we just talked about, right? Lower highs in the Russell underneath 1972. Underneath 1972, good to go. Trading this in the downward direction, rejecting all of this as overhead supply. If you are going to move in the upward direction more meaningfully, right, we need to see that recapture of 2,000. 2,000 is the number. It would require moving through all of this consolidation and into the single prints from, what period is that? Is that A? No, it's K. Into this K period single prints. So, over 2,000, you don't really have much in the way of at least getting a rotation into like 2018. That's definitely a possibility out of the Russell, but there's just so much work to do before that's even in force, right? So the name of the game is 2,000 on the Russell futures and 196.50 on the IWM cash. Let's get granular and take a look at the weekly performance of our S&P sectors. Leading the pack here is the XLV healthcare sector, up 0.7%. As we know, it is D for defensive classically, but it's also the second heaviest weighted sector by market cap. So on a day where there's a breakdown, if anything's going to lead, or on a week where there's a breakdown, if anything's going to lead, the XLV is a great leader to have up there because of its weighting in the S&P. Notice it's followed by the XLF, which is a little bit interesting considering the bank blow up this morning. And then directly underneath, we have utilities and and consumer staples. At the bottom of the barrel this week is the XLC for communications. Obviously, your Google gap down has a lot to do with that. The XLK is weak this week as well. Microsoft, of course, having some impact there. Apple earnings will have a lot of impact as well. The SMH is down, right? And all of these heavier weight risk on style sectors, they're pulling back from all-time highs. And that's really what I meant earlier by saying there's not as much concern here in the sectors than maybe meets the eye. Short-term downside momentum, yeah, but posture-wise, anything like big glaring red flags, no. I mean, if this was being led by lighter weights and the heavier weight sectors are outperforming, it'd be like, okay, why is the market breaking down under those circumstances? But it's not. This is sort of the natural, rotation of a pullback where the heavier weight risk on sectors take a back seat and the lighter weight sectors, as we're pulling back, try to pull their weight. They try to pick up the slack. It dampens some of the impact, at least in the S&P, compared to something more tech concentrated like the NASDAQ. And, as and if we can spot the daily higher low, what we want to see happen, just to give you the heads up, like you need to watch for this in real time, is when we start seeing, if we start seeing buyers step up at these levels, 477.50 or the 482.85 level we just talked about in the hourly analysis of the S&P, right? The sweep and then weekly close back above. If you see that, you want to start seeing outperformance on a relative basis from your XLK. Like if we close a weekly bar back above this level, can we find like the Friday or Thursday session green on the day out of the XLK? That would be a big first signal, right? Let's check in on the structural charts though and evaluate what's happening from a structural point of view. Let's take a closer zoom at the XLV. Big gap up this morning. Again, no issues out of this. Possibility for a higher low here. It's the second heaviest weighted sector by market cap. Yes, D for defensive, but again, as we're pulling back, no issues posture-wise as we're getting that rotation here. The XLF, interesting again with that bank blow up this morning, but other than that, mild pullback on the week from the highest high in the trend sequence. Any higher lows over 38, again, there's got to be some give and take to the market. Higher low here would be like something out of a textbook. We'll see if we can get it, or if a higher low wants to form above 38, good to go as well. No issues there. XLU, again, it's green. It's outperforming on the week, technically. But is it, on a relative basis, taking out major structure? Is it in a big uptrend? The answer is simply no. So do we see a flight to safety into things like utilities? I would argue, again, the answer is no. Still an opportunity for a lower high underneath this as a double top. When and if these things start pushing to the upside in a big way and they're leading market rallies, that's where we're much more skeptical, and we just don't have that in the sort of sector breakdown that we've been going through. Here's the XLP. Look above and fail on the range. Wouldn't be surprised to see it rotate back down towards the bottom. So no issues on that, remembering that this is a lighter weight D for defensive sector. Let's see. So let's move on over to some of these heavier weight risk on sectors. Like if the XLC can go gap fill reversal, which doesn't look likely based on the daily bar structure, red inverted hammer after a gap down. So no love to close the gap overhead, closed weak on the lows. But let's say that we can do something like this, find a higher low out of the XLC, where the XLP finds a look above and fail here back down to the bottom end of the range. That rotation is A-okay for the market. That is not going to sink the ship over in the S&P. Something that would sink the ship is your XLP, lower low underneath the bottom end of the range, and the XLC, no higher low here underneath 73.25, right? Moving along to the XLK, the commentary here will be very similar. We're breaking down from an hourly head and shoulders up at the all-time high. Totally, justified. Looking for a higher low on the weekly or daily time frame chart. All of these gap fill reversal areas are potential areas of interest. The daily 50 SMA is sloping in the upward direction. No major concerns here. Again, into the end of the week, could we see continuation? Yeah. There's a solid red-bodied bar, momentum bar to the downside, but nothing to panic about yet from a structural trend-following point of view. We skipped over the SMH. Let's take a look here. Same concept, head and shoulders, upper wick rejecting that neckline. Again, thin structure to retrace. Yes. Could we continue lower into the end of the week? Yes. It looks likely based on that rejection of this 3-day balance here, but still looking for a structural higher low here, or off of 76.75? Yeah, 176.75 as your previous breakout level, right? Attempted gap fill reversal, partial gap close, and then off to the races. So it's very difficult to maintain an outright bearish stance for anything longer than maybe a little bit of continued pullback than really searching for these higher lows. Next up, real estate sector, rate sensitive. It still did not move into this balance. We'll be a little bit more concerned if we aggressively do something like this. Just not really a threat. It's too much of a lighter weight lightweight sector to have any more impact into the end of this week. Energy, trying to find that higher low here sets up another attempt. This was an inverted head and shoulders fake break. Let's see if we can get like a larger run, maybe like weekly, monthly inverted head and shoulders. If we can continue to build out higher low balance over like an 82.75, as long as it's neutral here and not collapsing, that's okay. Remember, we don't want the collapse in energy because it speaks to global demand for oil products diminishing and what that might impact economically across the global landscape. It's just more concerning for global growth to sustain itself, I suppose, as we're on this cusp of trying to land the plane for a soft landing, right? A lot of the commentary in Jerome Powell's press conference was like, hey, do you think a soft landing's possible? And he had to like sort of dance around the question. Here's the XLY. Break this trend line, I think we're good, but as of right now, not looking great. Not looking great. We know all the news about Tesla. The wild card here, of course, is Amazon earnings after the close on Thursday. So highly attentive to Amazon earnings there. If it does continue to push us in the downward direction, a little bit more concerned out of the XLY because we are starting to build out a more meaningful weekly downtrend. With this lower high sticking, we have not broken the top of the range. Lower low is sticking. It looks like a threat to the downside here. So small red flags starting to go off in something like discretionary. We'll keep an eye on it as we continue to potentially break down from this as overhead supply. Next level to watch underneath 167.65. Next up is going to be the XLI for industrials. Attempted new all-time high today. Could not get it done. So consolidation here is still healthy. Good to go. 8% of the S&P. It's certainly a helping force for keeping the market neutral instead of an outright breakdown. Structurally, it looks great. Still an opportunity for a higher low over 112.40. Last but certainly not least is your XLB for materials. And it's the lightest weight sector. So we're only going to be more concerned for downside on a breakdown of the pivot low. At 81.35, consolidation through here is about as neutral as it gets. And if it wants to take out the pivot high, which was basically set on the Tuesday session, over 84, great. It'll help the market. But again, being such a lightweight sector, we're not going to put all of our eggs in one basket. It's just one minor piece of supporting evidence. Here's the sector ratio grid. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. The XLK needs to find a higher low sooner rather than later up against the retest of the prior flat top from over here and our daily 50 SMA now acting as potential support. And the reason for that is if we see an uptick here, it gives an opportunity for the XLF to pull back potentially. And one of the wild cards, of course, as we talked about, is Amazon earnings for the XLY. If Amazon earnings go well and kick us up towards the 50 SMA, it would be logical to expect a pullback there for a potential lower high, which is why, again, we need to see that higher low out of the XLK sooner rather than later if we're going to maintain more of a risk-on style look for our market. The XLV poking up through the 50 SMA, it's not great, but if any of the risk-off indications are going to fire a little bit more bullish than bearish, it wants to be this one because of the sector weighting, right? The XLP is still underneath a descending 50 SMA, although creeping higher, we have to acknowledge that, right? And the same thing happening here with utilities. They're starting to creep higher, but they still very much so look like counter trend moves in the context of existing downtrends and downtrends here, which is not an issue from a risk on versus off point of view. Let's take a look at some specialized ratios. We have the XLK SHY pulling back aggressively, but still an opportunity for that higher low. This still looks risk on to me until the trend changes. Same thing here in the XLK over the XLU, higher low daily 50 SMA. Good to go. And here is our red flag, apples to apples on the XLY versus the XLP. You can clearly see how we're breaking down into this balance range a little bit more firmly now with a very nuanced lower high underneath the previous two equal lows. So keeping an eye on that, but remember, Amazon is our wild card tomorrow. After the close, they do report earnings. If it's a big beat, if it's a big gap up, certainly could envision some sort of move higher, but based on what's happened with Microsoft, Google, as well as AMD, unless they come out with something blockbuster and they're keeping some secrets in terms of AI, not necessarily convinced we're looking for anything over the top out of Amazon. So we'll see. We will take it in stride, but so far this is a minor red flag as we move towards the end of this week. Let's move along and take a look at the dollar, what's going on with our Dixie. Even with today's Fed volatility, the dollar didn't do much, and I'm fairly surprised by that. It remains resilient, and it's still trying to build out these blocks in the upward direction for a trend higher, but it didn't break out of the range, which is a little bit surprising to me. So watching to see if it wants to do that into the end of the week, that would sustain more of a pullback in the S&P. But if it breaks down, if it goes sideways and this consolidation eventually turns into overhead supply, that would be an added boost in confidence to saying, okay, we're certainly trying to step in and buy the higher lows in the S&P 500. Let's move along and take a look at the gold contract, the metals, just to see if we can gain any insights from these guys. Metals upper wick today, in gold at least. If we take a look at silver, silver's not really doing much. It's kind of sideways in here. Maybe inverted head and shoulders, and if we're higher here, we're expecting lower lower in the dollar. So that's one potential tailwind for the higher low thesis in equities down below. But so far, these things are fairly muted, which is surprising given the FOMC today. Let's take a look at the TNX, which is the 10-year rate, obviously, and it moved lower aggressively. And you might think to yourself, and you scratch your head here, why is the 10-year moving lower if Jerome Powell was a little bit more hawkish today compared to anything else? And really, I think it comes on the heels of his comment where he said, hey, we've really achieved the highest rate for Fed policy that we're expecting during this cycle. So people are saying, all right, we've topped out in interest rates, basically. Is that what you're saying? And although he's not going to say that explicitly, it's kind of what we can infer from his commentary there. Now, it's still higher for longer, but we're not expecting any big ramps back up towards this 5% mark in the TNX, unless there's some sort of change in tone from the data that's coming in. But so far, so good. Let's move along and take a look at what's happening with the inverted ZT for expectations on the 2-year, and it's slightly lower. And again, I think it's the same commentary where the market basically understood today that we've reached peak rates and we are looking for lower from here. Not in March. Jerome Powell is very clear about that, but over time, going to start looking for some cuts down the pipeline. So interestingly enough, even with the inverted ZT lower, the tracker tool is suggesting that the market is betting against Jerome Powell. Current policy sits at 525 to 550, and we're pricing in a cut as soon as March of 2024. And if you were watching the press conference, Jerome Powell basically answered verbatim a question, will we see a cut in March? And he said the answer is no. So why might the market be pricing this in with roughly 53% odds currently of a cut in March? And number one comes down to trying to get ahead of a potentially weakening labor market. If you saw the ADP non-farms on Tuesday, not the greatest read, but also not terrible. But we are getting some anecdotal evidence about potential layoffs. You know, XYZ company is cutting 9% of the headcount, 8% of the headcount. So anecdotally, yeah, it's becoming a little bit of an issue. We'll see tomorrow on the initial claims week over week whether or not we see a tick in the upward direction. And then Friday is the big deal. So in my eyes, looking out for the reaction and where this table closes out after the bell rings on Friday at 4 p.m. Eastern time will be the largest tell. The other more sinister reason might be number two, which kind of got swept under the rug today at the press conference. Nobody asked about the bank blowup in the New York Community Bank. Why was that not a topic of discussion? Now, I do believe that some henchmen, for a lack of a better term, were sent out from the Fed to sort of quell fears around that. And they said, no, it's not systemic. It's more of an isolated event. And they sort of tried to put a damper on it. But it was not, like, nobody even mentioned it at the press conference. So those are the two reasons why I could potentially see the market trying to get ahead of the game here and call the bluff from Powell. Let's take a look at the calendar. And you can see there's JOLTS, which came in strong. And here's the ADP non-farm, which came in a little bit weaker than the expectation, 107,000 versus the 148. On the Thursday session, so tomorrow morning at 8:30, 213,000 versus the 214 prior. And remember that as long as we're underneath 250,000 on the initial claims, it's not really going to move the needle down here for the month-over-month read. Now, of course, this won't be impacting the Friday report at 8:30. And remember, coffee and donuts up in the penthouse for that release. It'll be a good time. We get hourly earnings, NFP, and the unemployment rate on the month-over-month read. Still expecting historically low unemployment, 3.8. And I really don't see a reason for this to come in as a miss, considering all of the unemployment initial claims we've been monitoring on the week-over-week sort of readings. Nothing has really been a huge miss in the upward direction. The last read was a bit of a miss, but again, nothing in relationship to that 250,000 threshold up here, where we know initial claims tend to normalize. Let's take a brief glance at the QRA announcement. This happened at 8:30 this morning, and what you'll notice is that we actually saw increased issuance in the 2, 3, 5, and 7 year. So technically, when they issue more bonds, right, what does that do? It drives the price of bonds in the downward direction, and therefore yield needs to move in the upward direction. So the shorter end of the curve was a little bit more impacted here. No big changes in the 10-year, 20, and 30-year. So it's kind of a nothing burger, to be honest with you. If anything, it would just suggest that Janet Yellen is willing to, bend and flex to the needs, the liquidity needs of the market to ensure that the auctions continue to go well. Let's take a look at the earnings calendar. This is going to be a big deal into the end of this week. Apple, Amazon, and Meta. These guys need to report. They need to bring home the cheddar, because we know if Jerome Powell is right about not cutting in March, then the PE ratio needs to move in the downward direction to represent not getting all 6 anticipated rate cuts for 2024. We'll see a little bit of a contraction of that multiple. And the only way to counterbalance that is if we see blockbuster numbers in the blended earnings for the S&P move in the upward direction. The biggest drivers of that will be the Magnificent Seven. So it's really all eyes on Apple, Amazon, and Meta. And then we go through a brief pause until NVIDIA reports later on in the February timeframe. So overall, topic of discussion is the multiple expansion rally going to come to an end here with Powell saying no go? Or is the market pricing it in properly, anticipating the risks and trying to get ahead of that? That is the main watch. And again, the biggest mover here, or the biggest takeaway, will be Friday after the close once the labor market report has settled out from the 8:30 morning time frame. What about the risk appetite of the market? As we mentioned earlier, not the biggest deal. The TLT is starting to show some early warning signs of like maybe pay attention to this. However, if we take a look at what's happening with bonds in relationship to themselves, they actually ticked in the downward direction here on the QRA and just over the past couple of trading sessions. So what that would tend to suggest to me, and we know that Powell also announced, hey, we've reached the highest highs that will go with policy. So there shouldn't really be a preference for shorter dated bonds anymore as that starts to phase out and we potentially look forward to the normalization of the yield curve basically and a lack of preference for the shorter duration time frame. So risk appetite remains sturdy down below as long as these lower highs tend to stick here, and I don't see a reason for them not to. And if we're thinking about the New York Community Bank that we discussed just a moment ago and the implications of maybe a credit event, let's take a look at what happened here in credit spreads. Sure, there's an uptick today. But is this an Armageddon uptick? And just for comparison's sake, I highlighted in red over here. This is the SVB breakdown over like a multi-day span, like 1-2 days, and we're doing something like this. And again, maybe this could be the beginnings, but we're certainly not at a point right now where this is a large threat for the credit worthiness of the market down below. So not pricing in some sort of credit event based on credit spreads currently. Let's move along and take a look at high yield in isolation. And this is honestly starting to diverge in a positive way where you'll start to, just understand that this as an equal high is different from, sure, this is still pulling back, but if this just hovers around this on the pullback as we're maintaining the equal high up here, that would start to act as more of a positive divergence instead of a negative one. So watching that out of high yield, let's move along and take a look at Bitcoin briefly. Moving back into the midpoint of this range. Remember I said I would have to eat my words, and I certainly am. So drifting lower, if a higher low can hold over $40,662, great, that's okay. Remember that this is your key hold now. You can't afford to get down underneath the pullback low closer to 38.8 out of Bitcoin. Otherwise, the door is open for this. This is distribution. You trapped buyers, lower high, and it's bad, right? It is a bad look to take out that low. So it needs to hold inside of the original range if you're going to remain constructive on crypto there. Now let's take a look at some market breadth because again, this is actually helping. Notice that breadth ticked in the upward direction even as we get this very aggressive pullback in the S&P on today's session. So beautiful out of breadth here. If we take a look at the SPX A200R, any concerns? Not really. A mild downtick. Remember, this is a weekly time frame chart. This is not a daily. So this week hardly changed from the previous week. The SPX A200, 50R is the largest impact here with a bigger downdraft, but still the argument has been for a while now, and I'll continue to stand by this one as long as new highs versus lows is looking good, credit spreads are looking good, as long as the risk appetite indications are looking good. This is going to leave the door open for any higher lows that start to rebound, a stronger opportunity for the breadth to be recaptured as a whole across the broad market, right? If this comes in for a higher low and suddenly more companies start rallying in the upward direction and this upticks, it's never going to stay pegged up in this trend higher zone over 80%. So some give and take up here as we're looking for something to remain structurally healthy in the S&P is not the end of the world. So, larger concerns, just to give you a blanket idea, larger concerns when we break 50%. Simple as that out of the SPX A50R. What about the RSP equal weight S&P 500? Even with today's breakdown, we're still inside of this balance range. It's very, I wouldn't say anything overly bearish about this look and say, no, the equal weight is suggesting doom and gloom. We've got to see this deep, dark, pullback and it's going to get nasty out there in the market. Not by any stretch. As long as this can potentially hold a higher low over this swing low back here and the weighted market finds a higher low over the top of the range, that would be beautiful to me in terms of market breadth. The equal weight NASDAQ is going to be much more on par with like a 1-to-1 movement. You can see here we are versus here we are on the weighted down below. So a retest of the highs. We're basically at a retest of the highs. We saw that on the QQQ as well. No big deals with that one down below. Let's move along and look at the Dow and what's happening with the industrial versus transport. So pulling back, this has been divergent for a while. This continues to be a back pocket piece of information for any bears out there who are saying, no, we don't trust this all-time high as far as we can throw it. Here's the VIX, a little bit of an uptick today with the FOMC volatility, but did we break 15? The answer is no. What about the VVIX as a precursor to the VIX itself? It's really just in the midpoint of this as a range. It's in a healthy spot. Remember, complacency zone is down here at 75. We don't want to be hard pressed to just, consolidate down there and stay there. So being in the midpoint, it's healthy. It leaves the door open for like people are on edge. There's two-sided trade happening in the market. It's not just dominated by the buyers, and suddenly all it takes is this little rug pull, and we're crashing aggressively because this is complacent, and boom, it rockets like that. So no issues out of volatility, and that's also supported by what we see here in the VIX futures, strong contango, staying underneath zero, and the one-day VIX, it certainly spiked today, but it closed in a very meaningful place right at the cusp of this level right here. If we drift lower into the end of the week, that would suggest to me that we're still on board for the higher low pullback thesis. If you've made it to this point in the video, do me a favor, hit the thumbs up button, subscribe, all that good stuff. I'm sure you're enjoying the analysis, and we'll kick off the core list of companies with Apple. What do we see on Apple? Well, first and foremost, anything with earnings tomorrow after the close, I will likely not be trading, so don't get a false sense of confidence just because we talked about a setup here. It's very unlikely I will actually put my hard-earned dollars on the line trading ahead of these earnings announcements. I'll be focused on things that have either already reported or aren't reporting for quite some time. Apple's daily chart risk is that this turns into a double top and we fail underneath this as a neckline. A larger breakdown of 180 continues to unlock thin structural retracement back here. Let's take it on down to the hourly chart and just start to understand that we have seen about a 100% retracement. Generally speaking, if we can close this gap a little bit further, then see that 200 SMA, it's very unlikely that you see a 100% retracement and then immediate continuation through that level. You more often than not see a lower high that's produced here, and the lower high that you want to watch out for is anything underneath 188.50 out of Apple. So we'll leave it off at that, being a little bit more broad because, again, not a primary candidate to trade tomorrow morning considering the earnings and implied volatility on the options chain. Here's Microsoft. It really didn't gap down aggressively like we saw out of Google and AMD, but it did do something interesting in terms of putting in an excess high, and this is what we were referring to on the SPY, or even just the ES on the market profile, saying that if we need to clean up the highs, look for something very similar to Microsoft. Big, excess high put in, and then a very, very weak close down at the bottom of the move here. So overall, there's an opportunity for a weekly higher low, even a daily higher low. There was no hourly downtrend here. There was no hourly downtrend here. This may be a little bit. So as long as your higher low is above 380, 380 on Microsoft, kind of good to go. I'm watching these three equal lows very closely. If we can sweep that, find a higher low here, that to me would remain the most constructive for Microsoft. You get this nasty bearish engulfer. You find support on the repair of these lows, and the buyers step back in. I mean, what else could you ask for in terms of an uptrend at all-time highs, even in a fairly, poorly received, I should say. It's not that the earnings were bad necessarily. They were just not up to the expectation of the market, basically. So again, what else could you ask for? Higher low repairs the structure and then back in the upward direction, good to go. Here it is on the hourly time frame chart, and you can start to see how maybe it's a double bottom around this area here, right? Maybe there's an inverted head and shoulders that sweeps up and cleans these equal lows, and then we're back higher with a higher low here. And then, of course, what's the target? Everybody, let's say this in unison, it has to be 402.75. If this is going to continue to act as overhead supply, and Microsoft is going to do something more damaging on the weekly time frame chart, a daily lower high that's yielded here, so highs, lower highs, obviously much more concerning. 402.75 is a top watch for that particular reason. So that's where my head's at, looking for buyers to step up, maybe an oversold reaction here, and then reevaluating at 402.75. Next up, Google, major gap down, obviously ground control, the major Tom. What do we have going on? These types of plays are always, they're less interesting to me. I would prefer to trade just straight up price action, normal conditions. So given that we have a gap down, there's one classic setup that you can almost always look for when you have a gap and go to this magnitude, right? This is consolidation, and obviously we broke down into the close, so the bears do have an upper hand, but if those shorts are going to squeeze out of Google, and I'll show you a similar example on Tesla in just a second, you can always just mark off where that consolidation high is, and your long is quite simply over 142.15, squeezes out the shorts to go back up and tag the opening of today's gap down, right? So loosely 144. So that's your upside trade. To the downside, any continued consolidation down here builds out more of a flag, then maybe we can try to trade it in the downward direction. But again, my MO is not trying to force new money shorts dead on the lows of a big gap down to this magnitude. So Google's a little bit less attractive for that reasoning. Microsoft is great. Maybe Google up and over those flat tops to squeeze the shorts that we just talked about, but that's about it. Amazon, great lower high here on the retest of your head and shoulders, right? Amazon earnings, unfortunately, tomorrow mean that this is rendered basically useless to me as we start trading tomorrow. Now, a larger thing to at least consider. So maybe if you're interested in Amazon, this is sort of the high level overview, right, is do we find buyers on the retest of this level for tomorrow morning's open ahead of the earnings announcement? If we do, then great. If you're like diehard trying to trade Amazon, there you go. A higher low there makes sense from a weekly point of view. You have lows, higher lows, weekly higher lows. That's great. Anything other than that, really waiting until after earnings. So 155.25 is that number. Next up, NVIDIA. What's going on with NVDA? Great little balance area building out up here. It's not as bearish as it could possibly be. Reasoning for that, if we take a look over here, is notice that on the open, we rejected with this upper wick, partial gap fill, and then started to push underneath this major area at 609.50. So these equal lows technically unlock thin structure through this breakout on the Wednesday session of 2 weeks ago, and the sellers could not accelerate there. Even on the FOMC, notice the volatility, very, very contained. So there wasn't as much impact here on NVIDIA, and for that reason, this balance strikes me as being healthy and bullish. If we can clear the 617 area, looking for the equal high to be produced towards the top of the range at 626.75, and then looking for upside after that on any higher lows above. But the trade into the end of the week looks certainly something like that. If we are looking for the bears to gain a little bit more of a stronger foothold, it's got to be the lower high underneath, 609.50. NVIDIA, for the reason of not having earnings and also having very clear price action structure, will be a top watch into the end of this week. Meta. Earnings, right? So earnings. Be aware of that on Thursday, tomorrow after the close. Nice hourly lower high underneath 395.25. If we take it on down, or up, I should say, to the daily time frame chart, your stronger daily higher low pullback is the retest of this breakout point here and a gap close at 376.50. Daily inverted hammer looks weak. Hourly lower high underneath the level. Partial gap close, not suggesting that we have stronger buyers. To me, breakdown here, door is open for this, but remember, earnings are your monkey wrench in the mix. So 388 is your key watch. If we break it, looking for something around 376.50, but that's your high level overview. And we're moving along to something like Tesla. Tesla on the daily chart is worth just pointing out that we do have our trend channel to the downside. We're trying to find buyers off of the low, but we didn't really get much acceptance into the gap overhead. Let's take it on down to the hourly time frame chart. And there's two things I want to point out. First and foremost, as we were talking about on Google, if we can break out over the equal highs, that would be the equivalent of a very similar idea here out of Tesla. Notice this break on the hold of that. It's the squeezing of these shorts at the worst possible location. Let's quickly flip back to Google just so you can get the same idea, right? It's the move over this squeezes out our shorts late to the party. Again, that level in Google is 142.15. But back to Tesla, taking a closer look over here, you can see in the gap, we didn't really get much acceptance. We rejected it today on the FOMC. So if this is going to start acting as your lower high, it's all about that 185.50. If we slip it, door is open for lower. This is just a total, failed daily lower high, basically looking for equal low breakdowns, and the bears remain, total control of Tesla. Sure, we're bobbing around near the lower bound of the daily trend channel, but the hourly chart is not suggesting that stronger buyers are stepping up. Thin structure, oversold potentially conditions. Like it was just a quick pop, short squeeze, and that was it. We don't really have sustained buying pressure here in Tesla. Last but certainly not least, to round out the core list, and then we'll jump into some trade ideas. It's three of them. Netflix. Netflix is starting to show a little bit of our infamous man ray pattern. That right shoulder is trying to build out, and I would really watch for the failure of this zone. It's technically could also be the neckline if you use a trend line like that, but 558.25 has already offered a beautiful gap fill reversal or just a retest of the breakout point on the Friday session of last week. And now this week, you can see that we're just grinding around sideways up here. So it either needs to hold and we'll just, be patient and look for something like this back up towards the highs, 569, or a larger breakdown of that. And I think that we can, the question becomes what happens with the earnings gap, right? Maybe earnings go sour in your Apple, in your Amazon, in your Meta, and all of a sudden the tech cohort in general starts to see a larger downdraft. I could see Netflix being a little bit more impacted by your Meta just because it's part of the XLC communications sector, and the weighting there will pull on it to the downside. So keeping an open mind to that, but that's only on a failure of 558.25. So far, a little bit more neutral. Notice that the consolidation held into the afternoon instead of FOMC volatility really weighing on this and even attempting any interaction with that 558.25. So for that point, I'd be a little bit more neutral on Netflix. Let's move along into our three ideas. V is up first. That is Visa. Earnings are in the rearview mirror. This has a lot to do with the financial sector. If the financial sector is going to outperform, which we just talked about on the actual structural chart itself, you want Visa to produce a higher low here at 272.50. The options chain is decent on Visa. It's a contender. Break, higher low retest, and looking for upward lift back towards your equal high. 278 is on the radar. If we slip underneath this is where things become a little bit more of an issue because now this is not holding as obviously a potential higher low, and this is thin structure that we just saw. on the hourly chart, right? So if we're going to retrace through that, a lower high underneath 271.25 has the opportunity to do more damage to the XLF as a sector, and obviously Visa as a component could be an individual trade that you pick off from that. So 271.25 top watch needs to hold, but more interested in, can we find to trade in the direction of the prevailing winds, which are up? Can we find the double bottom? Can we find the inverted head and shoulders? Can we find the daily hammer candle here to pick it back up for upside? That's Visa. Next up is LEN for Lennar, home builders, of course. And these guys are extremely rate sensitive. Let's go to the daily chart first, right? Here's your balance range. We talked about this level here. It was very equivalent over on DR Horton. DHI is the ticker. That was an idea from the Saturday update. But look at the back-to-back inverted hammers. Technically today is a bearish engulfer. And if we can break down underneath this inflection point at 149.50, the rotation is back down towards the bottom end of the range, 144.65. That would be your daily bottom end of the balance range. From there, certainly monitoring for continuation, considering that this is from here to here already a set of lower highs. Equal lows after lower highs, generally speaking, tend to open or increase the odds of a breakdown there instead of a hold, right? First test, best test, and then if you start testing it in short proximity of time after a lower high, a little bit more dangerous. So Lennar, downside there. CZR is going to wrap us up, and what do we see out of Caesars? There's your head. It's actually a head and shoulders within a head and shoulders, right? There's the head and shoulders major. Here's the head and shoulders minor. There's your right shoulder. If we can break down more firmly from this balance, and again, inverted hammer, larger upper wick, rejecting this as overhead supply. The door is open for probably something down. It's really not that attractive of a range. The only reason I included this is because it's easy to borrow in Thinkorswim, at least. I would have to imagine it's easy to borrow on any major broker. But if you're looking for a short at a cheaper price point via shares, this is a potential contender. Here it is on the hourly time frame chart. Again, the idea, turn this into overhead supply, look for it to weigh on price action lower, and it's almost a beautiful range double into our previous daily lows at 42. Let's round off there to 80, 42.80. All right. That is your last idea for today's session. I hope that today was a beneficial one for you. We will see you in the penthouse for Friday, obviously Thursday as well, but Friday coffee and donuts, complimentary on me. The rule is if you want something other than coffee and donuts, just bring enough for everybody, and we'll have ourselves a nice little morning session up there. So with that said, I wish you a green trading week, and I will see you in the next one.